Imagine walking into a bank to deposit $1,000. It's natural to assume that the bank takes your physical bills and keeps them securely stored in a vault until the day you come back to withdraw them. In reality, the bank only holds on to a small fraction of that deposit, typically about 10%. They take the remaining $900 and immediately lend it out to other customers. This creates a strange paradox. If the bank just gave away 90% of your cash, your banking app should show a balance of $100. Instead, it still says you have a full $1,000. The numbers on your digital screen aren't a direct representation of paper bills in a drawer. Commercial banks act as engines of money creation, generating new capital every single day. We can track how this expansion works by following the path of that missing $900. When the borrower spends that $900, the recipient eventually deposits it into a completely different bank. This second bank follows the same rule. It keeps 10%, $90, and lends out the remaining $810. That $810 is spent, deposited into a third bank, and split once more. This cycle repeats over and over, rippling across the entire global banking network. Through this repeated process of lending and redepositing, a single $1,000 deposit can expand the money supply by up to $10,000. This systemic process is known as fractional reserve banking. By continuously cycling these loans, the banking system increases the total amount of money in the economy without needing a government to print a single new physical bill. Because of this expansion, the vast majority of our money exists only as digital credit rather than physical cash. When you take out a mortgage to buy a home, the bank isn't handing you a briefcase filled with someone else's life savings. Instead, the bank simply types the loan amount into your account, effectively creating that money the moment you sign the deed. Borrowing is the essential fuel for this system. Without a constant flow of new debt, the creation of money stops and the economy stalls. Central banks are tasked with keeping this money creation machine from spinning out of control. Their primary tool is the interest rate. Lowering rates makes borrowing cheaper, which encourages more loans and pushes more new money into the economy. Raising those rates makes borrowing expensive, which results in fewer loans and slows the entry of new money into the system. Interest rates serve as the control valve, determining exactly how fast everyday banks are allowed to expand the money supply. This design is inherently fragile. The system only remains stable as long as debt continues to grow and borrowers continue to repay. The 2008 financial crisis serves as a stark example of what happens when this debt engine overheats. Banks created enormous amounts of money through explosive mortgage lending, inflating a housing bubble that eventually became unsustainable. When borrowers began to default on those mortgages, the foundation of the entire credit system cracked. The digital money built on top of those loans became unstable, causing global credit markets to freeze. Because modern money is created through debt, the failure of those loans threatened to collapse the total supply of money itself. If every customer walked into their bank today and asked for their physical cash, the vaults would be empty long before the line reached the door. This is a bank run. It is one of the oldest fears in finance, because the physical cash required to cover every digital balance simply does not exist. To prevent this panic, governments insure deposits and act as backstops to ensure that the system remains functional. The modern financial system isn't backed by gold or steel vaults. It is held together by human trust. The next time you see a balance in your account, remember that in this system, money is just debt wearing a different name.